Hello, everybody. Happy Wednesday, and long time no see. It has been about maybe 3 months since I have recorded one of these episodes. There's been a lot of exciting changes going on here at work that I am sure I will talk about soon, but I wanted to be sure to squeeze this one in before the end of the year because we're going to talk about the One Big Beautiful Bill Act and how it affects this year's taxes and next year's taxes and so on. But there are some pretty major changes to the tax code in the One Big Beautiful Bill Act. We will by no means go over all of those changes in this episode. It's very large, very comprehensive, and this coverage will not be as comprehensive, but I hope it will be relevant. And so let's get started. So obviously a huge bill. Lots of tax changes around businesses, depreciation, business deductions. If you've been following that, you would see that the bonus appreciation is now permanently 100% for property acquired and placed in service on January 19th of this year or after that. Some other changes include special depreciation allowance for qualified production property, increased amount of deductible business expense. And then if you're a farmer, capital gains taxes on farmland can be spread out over 4 years now. So all very exciting stuff. Lots of changes around energy production. No more nuclear power credit for foreign entities. No more clean vehicle credit on cars purchased after, September 30th or later. EV credits are gone. No more sustainable aviation fuel credit. No more wind energy credit after 2027. No more metallurgical coal credit after 2029, whatever that means. No more energy efficient home improvement credit after this year. And no more residential clean energy credit after this year. So lots of changes on that front as well. But the changes you probably care about would relate to your personal income taxes. So that's what we're going to cover today. If you didn't know, the One Big Beautiful Bill Act essentially extends the Tax Cuts and Jobs Act of 2017. So a lot of the changes have to do with that. For instance, the standard deduction this year is $31,500 married filing jointly. That's $31,500 married filing jointly. And it is going to stay at that pace and increase with inflation. And if you are 65 and older or are blind, you get $1,600 more per person who that applies to married filing jointly. Another big change to this year's taxes is the SALT deduction, state and local tax deduction that is part of your itemized deductions, has increased from $10,000 to you can now deduct up to $40,000. And that is through 2029. So it starts this year and then through 2029. This does decrease if your modified adjusted gross income exceeds $500,000. But that's a big change this year. Okay, let's go over some other quick changes before I go over my favorite one. Child tax credits increased from $2,000 to $2,200. Up to $5,000 of adoption credit is now counted as a refundable tax credit. Refundable means you could get it paid back even if you owe no tax liability. A massive $25,000 deductions for money earned on tips. I do not mean the Treasury inflation-protected securities. I am talking about tips from a job that are given to you voluntarily. This deduction is considered a universal below-the-line deduction. I'm going to say universal to mean that you get it whether you itemize or take standard deduction, but you get it below the line, which means that it is after your adjusted gross income. And this phases out at $300,000 modified adjusted gross income for married filing jointly people. Another massive $25,000 deduction on overtime work, and this is very similar. Phases out at $300,000 and is a universal below-the-line deduction. And that is only here through 2028, over the next 4 years. Another change if you have a car loan, stop it. Probably don't do that. But you could get a deduction on the interest as a universal below the line deduction, up to $10,000 deduction on the interest you pay on the car, similar to how you might get a deduction on the interest you pay on a house. This phases out pretty low at $200,000 married filing jointly, and it is only here through 2028. What else? 529 plans, those savings plans for education for kids, they have been extended to essentially include any post-high school programs, trade schools, or any of that sort. There are, in a similar vein, there are enhanced, improved definitions around ABLE accounts as well and how those can be used. Increased AMT exemption, more favorable rules around personal casualty loss and theft deduction. Another change was $1,000 to be deposited to any children who are born from 2025 through 2028, put into their Trump accounts. This is a very unique type of account that we will not cover today, but essentially it is a account that could be used for qualified expenses after the child is 18 and must be pulled by the time they're 31. And that is $1,000 to any child born from 2025 to 2028. You could contribute up to, I think it's like $5,000 contribution limit to yourself, but $1,000 goes into that account automatically. Pretty interesting. Okay, my favorite tax change starting this year is up to $6,000 senior deduction if you are turning 65 this year or are already 65 or older. This is also a universal below the line deduction. That is important because a lot of things are going to look at your modified adjusted gross income. So how much of your Social Security is taxed, how much you pay in Medicare premiums, certain medications you need to keep your adjusted gross income under a certain threshold. This deduction does not help you do that. All this deduction does is help lower your tax bill. It lowers your AGI. It is a below the line deduction, $6,000 per individual that you get whether you itemize or not. So it's universal. Now, this is temporary through 2028. So only this year for a total of 4 years. And it phases out also pretty low at $150,000 modified adjusted gross income, married filing jointly. Much lower than that for single. I believe it's half. So huge as far as converting more money than you had planned to in 2025. Right now, your Roth conversions could be bigger than you had previously expected. Again, this deduction does not help you to lower your income below a threshold for Medicare premiums or Social Security taxation, anything like that. That is my favorite change in 2025. There are some changes that don't start until 2026 that I want to go over quickly just so that we can be prepared for them, but this will not affect your taxes in April. They are interesting nonetheless. Starting in 2026, mortgage insurance premiums, your PMI, that counts as an itemized deduction. So right now, like I said earlier, your mortgage interest already counts as an itemized deduction. Your PMI would count as well. Another change starting in 2026 is a reduction of itemized expenses for those who are in the 37% bracket, the highest bracket. You do not get to itemize as much as you would have if you were in that bracket. A new 0.5% floor on itemizers as far as how much charitable contribution you can deduct. What do I mean by that? So you could only deduct the charitable contribution that exceeds 0.5% of your adjusted gross income. If your AGI is $100,000, then you could only deduct the charitable contributions that you made over $500 or 0.5% of your AGI. Yet no more than 60%. That's always been the rule. Otherwise, you have to carry it over. And that is now permanent, actually. The 60% deduction on cash donations. 60% of your AGI on cash donations. That is permanent. It was set to drop to 50%. Now it will not. Now, I saved the most interesting starting 2026 rule for last. Starting next year, an above-the-line deductions for up to $2,000, married filing jointly, for charitable contribution. What did I just say? That if you and your spouse give $2,000 to charity, you can count up to $2,000 as a above-the-line deduction. That means you can take the standard deduction, which this year is $31,500, and you can reduce your tax liability by $2,000 of charitable giving, even though you took the standard deduction. Usually charitable giving is an itemized deduction. What's worse for the itemizer is that this only applies to those who did not itemize. If you are going to itemize, you do not get this above the line deduction. It still is lumped together with your itemized deduction. So, you could get the full standard deduction next year, maybe about $32,000, and get up to $2,000 per couple off your tax liability for the giving that you gave, which to my knowledge has never happened before. Pretty interesting stuff. But those are the bulk of the tax changes that we can expect. Again, probably the biggest thing that's going on right now is that if you're 65 or older, you get a $6,000 below the line universal deduction for each of you that phases out at $150,000 modified adjusted gross income. And this is temporary, only for the next 4 years. So again, if you're making conversions this year, make sure that you are factoring in that new $6,000 per person deduction into your taxes. That is the bulk of what I wanted to cover out of the One Big Beautiful Bill. Again, not at all comprehensive, but hopefully relevant. So I hope you have a good day, and I will talk to y'all later.